Everyone, welcome back. Next up, we've got Matt Caruso, top performer in the 2020 U.S. Investing Championship and a professional investor. Matt's going to be talking about the importance of aligning your strategy with your goals. Matt, thanks so much for being a speaker. We really appreciate it. And yeah, welcome.
Yeah, thanks for having me, Richard.
Of course, no problem. I'll let you get to it, and I'll be monitoring the chat, taking any questions, and then we'll do the Q&A at the end. And yeah, looking forward to it.
Perfect. Thanks. Well, first off, thanks again for having me. It's been such a fantastic conference so far. I've been jumping in and out. And
welcome back. Next up, we've got Matt Caruso, top performer in the 2020. If you can mute the video in the background, that's what that echo is.
Oh, okay. So are we live now, or
we're live? It's no worries.
Let me mute that. Okay, perfect. Okay, so thanks again for having me. It's been a fantastic weekend. I've been jumping in and out of different speakers, and I've been learning a lot myself. I just want to start off by saying I really think there's never been a better time for an investor. I mean, it's the first time in history I really think the individual investor has an even playing field with the pros. There's cheap commissions, lightning execution, information is readily available, and real-time news through Twitter. I remember I started noticing the real game change when I had a Bloomberg, and I was getting news on Twitter before my Bloomberg feed would bring it up. So I said, oh, this is something new, and that was probably about 10 years ago. So I mean, it's just such a great time to be an individual investor. But I noticed that most people who come to me with questions about the market, they all have pretty much the same kind of issue. And I just realized that they don't understand how to put together all the information that is out there. I mean, there's information about technical analysis, fundamental analysis, and it's really information overload. So I thought it would be great to start this presentation really looking at how to define your goals, how to set up your strategy. So a lot of those questions would go away. I mean, sometimes people read one book, it confuses them because it contradicts what another book was saying. And I think unless you really define your system and your strategy, you're going to have a hard time putting all of this together. So, once you state your goal and your strategy, you really have to think about, what are the expected returns you're looking to seek? What's the acceptable risk that you're willing to take, and how much time you're going to put into this? So, last year I had a great year with the championship, but, I'm a professional investor. And from when I began investing, my goal was really to make as much money as possible. I was always cognizant of risk, but I really want to get in there and make really big returns. And I could deal with the risk that came with that. Some people can't. So it's important that you know what your lane is, what your personality is, and really what kind of a business do you want to run. So we're really all entrepreneurs when you come to the stock market and you invest full time, or even if you invest seriously. And most people don't realize all these different strategies is really just like kind of running different businesses. So for example, if you want to open a clothing store, I know this seems like quite a tangent from investing, but I mean, it's just the logic and the mindset behind it. If you were going to open a clothing store, you have to say to yourself, what kind of location do I want? Am I selling men's apparel, women's apparel? Am I going high end? Am I going low end? Am I doing quantity, quality? These are all the different questions that are really important when you decide what kind of a strategy you want to apply. And that's, really true when it comes to the stock market as well. So I think the best way to begin to center yourself is to really think, what's my mission? What are my principles? And what are the methods that I'm going to use? And, I think everyone here, we're really fortunate. William O'Neill, the founder of Investors Business Daily, who wrote his fantastic book, How to Make Money in Stocks. He put a system out there that I think so many of the successful people speaking this weekend are using some variation of that. And what really made that successful is that it's really a holistic system. It tells you what kind of stocks to buy, when to sell. I think most people will take that and add their own personal touch to it, and they'll grow with it. But in reality, the reason it's been successful and why I think it's stood the test of time is because it is a holistic approach. So, there's a mission involved, there's principles that underlie it, and there's methods to get it done. And, over the years, I was fortunate that I was able to kind of pivot in between different strategies. I started off with CANSLIM. Soon, I was kind of enthralled with the technical analysis aspect of it. So I kind of jumped into swing trading, futures trading. In the mid 2000s when I was starting out, kind of the hot thing was a commodity bull market because, the rise of China and all that. So I was trading commodities, and my first job out of university was a professional trader, market maker, and then it was like a day trading approach, which was very different. And because we were in Canada, we pretty much traded always commodity related stocks, and those kind of really crashed in 08 and 2012. So I really started to understand how to deal with, crash types of situations where these stocks were really falling off a cliff and getting obliterated. And just as I pivoted through all of these different strategies, it really started to jump out to me that the key condition between being successful for all of these approaches are these three principles. What's your mission? What are your principles? And how are your methods to get there? So, why is this, like, defining your mission important? Now, we're all out there to make as much money as we can, but when the market gets tough, when you fall out of sync with the market, and the market's going higher and you're not making any money and growth is out of favor, or you're a value investor and you're sitting there and there's these tech stocks with no earnings going nuts, and when your mission is determined and what you're looking to do, that's going to keep you centered. That's going to keep you focused and aligned in the tough times. I mean, nobody really needs, 100% focus when you're making money hand over fist. But I really like the Mike Tyson saying where, everyone has a plan until they get punched in the face. And when you get that punch in the face, suddenly you have to start to figure out exactly what it is that you're going to do. And so once you define that mission, you need your principles, so one of the principles that I learned from William O'Neill early on in my career, and I think was what, kept me alive through all the different strategy drifts and changes that I made, was really cutting my losses short. I think any investor who doesn't have that principle at some point in their career is either going to blow up or take such a dramatic drop that it won't really even justify the returns when they do make money. It's such a core component. And as I switched strategies over the years, because I had that element so ingrained in me from the very, very beginning, it's just that it was that logical center of my system at all times that, if I'm wrong, I'm going to get out. And that really saved me, even when I was completely way off of the target of where I should be in the marketplace. That really kept me alive and kept me ready to live and fight another day. And through all this learning process, I developed my methods. It's changed over time. But what I'm using right now is really a combination of everything I've done over the years. So let's take it's kind of like a look into how I would define myself. So my mission is really active growth investing. I want to buy and hold a stock that's experiencing secular growth during the accumulation phase of its cycle. The principles that are behind that is, my principle is that the anticipation of EPS growth, earnings per share growth, is what drives stock advances. So even though, that's why I always screen, that's why the CANSLIM formula is looking for strong earnings, strong sales growth. We all know that's historical information, but you're most likely to find a company that's growing very strongly with a company that's already grown very strongly. I mean, what are the odds of a stock that has 2% sales growth last quarter suddenly jumps up with 200% sales growth? Very, very unlikely. And the market is always pricing in the information that's readily available. So the fact that last quarter was priced in, what occurred is already priced into the share price, but they're always looking forward, always looking forward. That's why when one of these growth stocks has earnings and, we beat earnings estimates, but we're kind of lowering our guidance by a penny a share or by $5 million dollars of revenue, and the stock crashes. And people who are new to the business are saying, well, we don't understand. They beat last quarter. Why is the stock crashing? Just because next quarter sales are going to be slightly lower. And the real reason is because the stock price is where it is because there was an anticipation of what was already coming next. So any change in that anticipation is not only for next quarter, but that's going to be amplified for multiple quarters. Every investor is saying, well, look, I'm really valuing you very expensive here because I'm expecting you're going to grow 40% quarter after quarter after quarter. If you're telling me instead of 40% next quarter, you're talking 30%, I have to discount that along the whole curve of your growth trajectory. And that's why you have these very dramatic moves. So I really believe it's the anticipation of earnings growth that drives every stock advance. In different industries, there's different ways to gauge that. For example, commodities are very strong right now. Commodities are a little bit different from growth stocks because, every day the price of the product they're selling is changing. So if you're selling oil, for example, if you're a driller, if the price of oil starts to move up, we don't need to wait till next quarter to see what you're going to make. We know it's going to be more than what you were already forecasting. So that's why there's such a correlation to the commodity price. So every industry has its different variations, which you learn over time. But the underlying principle is that it's the anticipation of earnings growth that drives these stock advances. Another principle of mine is, very simply, I learned this from Paul Tudor Jones and Market Wizards. no stocks below the 200-day moving average. Very simple. And the biggest winners that I had in 2020, the real monster runs, I wasn't in there trying to pick up stocks at the bottom of the coronavirus crash and say, oh, let me get lucky. And if this can just get right back to the old highs, I'll make a killing. What really happened was the strongest stocks came up off the bottom first. All the stocks I bought were above not only the 200, but their 50-day moving average. And so my goal by having a very simple rule like that is really to just stay basically in the direction of trend. That really makes me a trend follower. Now, again, there's many ways that you can make profits in the market, but my approach is trend following. And, I have some very good friends of mine that are professional investors, and they don't have that principle, but they've adjusted their strategy in a different way to deal with buying stocks that are not in an uptrend. So whatever approach you have, you just need everything to really line up. And, one key tenet, I've meant multiple principles, but just another one to go over is I'm really looking for purchases that have at least a 5-to-1 risk reward. So if I'm going to risk $1, I want to make 5 when I'm right, because I don't know if it's been through so many years of changing strategies and learning different techniques. I know how each strategy can fail. I've seen it. I've seen, pros that are doing great and blow up. I mean, you hear about hedge fund managers that blow up all the time that are extremely successful. So if I'm going to lose money when I'm wrong, I want to make a lot of money when I'm right, because if I hit that losing streak, I don't want to have 30 trades in a row to get back to where I was. And, it also forces you to be selective when you have that kind of a parameter in your approach. So that really forces me to take a step back, stop the overtrading. I was listening to Jim Ropel earlier today, which was a fantastic, Q&A session. I think everyone should listen to that a few times. And, Jim really echoed that, you want to avoid the overtrading. And that's something that, especially for myself, where I was a day trader, it's not easy to do, because we're here, especially for myself, maybe when you do it professionally, is you're sitting in front of the screen all day. And, to get yourself to back off from putting a trade on is actually ends up being kind of pretty difficult to do. So that's a principle you have to have, is that you're not going to avoid the overtrading. And one way I do that is to kind of look at the chart, say, do I have 5 times my upside in this trade potentially? And if I don't, I have to pass on it. And so once you have your mission, once you have your principles, then you say, look, how am I going to drill down and find the right methods to satisfy my goal? And it's important that you think this way, because if you're using a technical tool such as a Bollinger Band or a Keltner Band or something that has you selling into strength very quickly in a move, if you're trying to find a big winner that's going to be a big success and just really run away, if the tools that you're using are going to counteract your goal, then the tool is not any good for you. So it doesn't mean that the tool itself is not a good tool, but it won't work with your strategy. And this is why so many people have so many questions when they start investing in the market, and they hear, like this weekend, we have so many fantastic presenters. Everyone has their own techniques and it works for them. But if your goal, if your mission and your strategy doesn't work with the tools they're talking about, doesn't make their tools non-functional or not effective, there's not effective with your strategy. So until you take the step back and you really start to look at, what am I trying to accomplish? What are the underlying principles of my approach and what methods am I going to use? Until you start taking the step back and building a cohesive strategy, you're always going to have these questions in your mind. It's always going to be confusing, and that you're always going to have this information overload. And it's really important that you can cut through all the noise and find the different tools that are going to satisfy your goals. And, one way I like to do that is whenever I'm looking at a new tool or a new approach, I always go back to examples of big winners that I've experienced or big winners that I've studied. And I want to make sure that they wouldn't have stopped me from being in a major winner. I mean, I think the 2 biggest risks in the market are, one, taking losses that are just way too big and blowing yourself out. And the second risk, especially with a strategy where you're an active growth investor looking for trends, the second big risk or mistake would be letting a major winner go way too soon. So whenever I look at a new tool, I look at some past winners and say, will it have messed me up in any of those 2 ways? And whatever strategy you're doing, whether it's swing trading, whether it's day trading, whether it's value investing, go back, look at ideal situations. See, this is an ideal situation. If in this ideal situation, this new tool would have messed me up, well, it's not going to work for you. So it's not going to work as part of your strategy. So let's take a quick example and look at Nvidia here. It's important to visualize the strategy as I mentioned before, I'm trying to buy stocks in their accumulation phase. This year is really the accumulation phase of Nvidia back in 2016 and 2017. So there's typically, a basing phase, an accumulation phase, topping phase, and a distribution phase. I haven't seen everyone speak this weekend. I feel very confident someone must have mentioned this already. If not, Stan Weinstein does a great job of talking about this, and Bill kind of alludes to it with base count. But really, for most active investors, active growth investors, the accumulation phase is where you want to participate. If you're in the basing phase, you're probably not getting a great return on your capital. If you're in the topping phase, your downside doesn't justify, the little bit of upside that you have. This is really the meat of where you want to participate. And so, it's really important to take a look at how does the stock act along this big run up. So once you visualize this, it starts to give you a lot of key information that you wouldn't necessarily realize. So a lot of people ask me, how long do you stay in? What's a typical holding period for you? What kind of gains are you looking to make? What can I expect to make? Well, the answers are all in the past stocks. And if you build a strategy to capture these kind of movements, well, go back to the stocks that made the moves that you're trying to capture and see what the stats were on those stocks. I mean, it's very similar to sports. You're looking at a player and you want to know, what's a good batting average for a player for baseball? Well, unless you study other baseball players, if you think, well, a good player should probably hit 7 out of 10 balls, or, get on base 8 out of 10 times. Well, unless you go back and look and say like, well, a guy with a 300 average is a very good performer, you're going to be way off. But the answer is very easy to find. Go check out some people who are already doing it. So if we take a look at Nvidia, this is just, the up leg here. And I just kind of broke it across the different legs and the different bases. So, first off, I think relative strength is so key. I heard Arusha speaking about that in his last presentation. And usually most stocks start with a really period of strong relative strength where the market is discovering that something is going on and they start to price it into the market. The best place to probably first buy a stock is after this first base. I mean, unless you're really keyed in, to what's going on with this company specifically, and you're positioning yourself prior to this up leg, you're going to miss that up leg. That's typically, I think, for investors who are industry specialized. So if you're a tech specialist or a commodity specialist, you can kind of see before the rest of us, generalists come on board that there's a move percolating here. But, it doesn't really matter. If you look at this entire up leg here, I looked at it from, the first base. You basically had a 785% gain in 2.5 years. So, it's just a monster move. So whether you caught the actual bottom way down here or you started buying it here, doesn't really make a huge difference. Because in reality, the fact that waiting for base one shows you that you're actually right about your thesis. So there's many times, even if you are an industry specialist, you're so focused on the key variables that you're not realizing that the market's not, seeing what you see. And so there's a long period where your capital can kind of remain unused and just stuck in a stock that's not yet recognized by the market. But the important point here is take a look at, what can you expect? Well, the first leg up of this move was 49 weeks and a 266% gain. So that's a fantastic move. It took almost a year. So if you're looking for 200% gainers, but you say, I don't want to be in a stock for more than a month, I can't sit through an earnings report, well, you're going to have to adjust your strategy. Because if you look at Nvidia, we had 3 major legs. Third leg was kind of weak. But, all of these legs, basically the longer the leg, the bigger the gain was. This isn't always the case, but typically it takes time for moves to happen. Also, look at the size of these bases. They were 14 weeks long, 13 weeks long, 8 weeks long. It takes time for a base to happen. And I always like to begin with weekly charts to get a sense of the overall move that's happening. I get part of the principles that I believe in is that, it's these big funds driving these big moves and these secular growth stories. And so these basing patterns take time to form. It takes time to get short-term traders to get tired of a stock. It takes time sometimes for fundamentals to catch up to what the market's been pricing in. And so it takes time. And people sometimes are unaware of how much time it takes because they never went back to study some of these past winners. So it's really important. Go back and mark up some charts. Look at time, look at depth, look at the kind of volatility that these different bases had. Another big misconception people have is they think that once you have a very big drop, like a 57% drop, there's more upside because just getting back to the old highs is a double. In reality, when there's a break that significant, there's a long period of time where a stock will underperform. Nvidia eventually went on to continue higher and be a big winner, but that's not typically the case. Typically, most stocks kind of like die off and never come back. In this case here, even though Nvidia did become a big winner again, for this next cycle, it was a big loser. I mean, you know how frustrating it would be in 2019 to have the stock market shooting higher, stocks like Shopify going crazy on the upside, and you're stuck in Nvidia down 57%, going nowhere. And so as an active investor, especially when you're a full-time investor, you have to always have your money working for you. And kind of being stuck in something like this for such a long period of time is just as bad as losing money almost, in a sense, because you're not bringing anything home. So it's really important that your money is always working for you. So visualize your strategy, visualize your mission. What are you trying to capture? If these are the legs that you're trying to capture, well, you have to be prepared to hold the stock for multiple weeks. If that's not acceptable to you, then maybe something swing trading is more acceptable to you. But there's the other pros and cons that come along with that as well. I was a day trader. I got so tired of being in stocks, seeing them explode higher, not knowing, but thinking that they would go much higher, but selling out for a short-term technical reason and being unable to get back in. I said, you know what? If I would have caught one of these stocks with proper positioning, I would have made way more than I would make in day trading my brains out every single day. And that's what happened last year's. I mean, in some of the individual trades I made more money than I made in whole years in the past. And so, it's really a matter of saying what works for you, what works best, and how are you going to achieve it. So I think if you take a step back and big picture, how are we going to get to where we want to go? So you want to, verbalize your goal. And I think there's two key components to finding these big winners is, you need the fundamentals, you need weekly patterns. And really what I like to use and what I want to focus on in today's presentation is short-term patterns. The fundamentals are so important to, narrow down what stocks to look at and really try and limit your universe of stocks to use your capital in the most efficient way. The weekly patterns define the scope, the character, discover opportunities, but really short-term patterns, what I find they do for me is they really maximize the risk versus reward. They provide multiple opportunities to get into the stock, and they provide adaptability. So, once you find a high probability target, one of the issues I had with CANSLIM and the approach that they took with the bases is that if you miss that ideal entry, you're kind of stuck waiting. And I just knew over time with experience with day trading and all the different swing trading I did that there are multiple ways to buy a stock. The logic behind the weekly patterns that Bill put out in his fantastic book is great. I still use those buy points. I just don't use them without other techniques. So I use multiple techniques. What I did was I took all the short-term patterns I learned over the years. I categorized them. I've read so many great books on this. There's candlestick books, bar pattern books. And I kind of realized that they kind of all different fit into 4 different categories. So if you look at short-term patterns specifically, there's coil patterns, there's breakout patterns, pullbacks, and what I call expectation breakers. So most people like to use breakouts. Basically we're looking at a breakout above a prior high, above resistance, usually with increasing volume. And there's good reason for that. I mean, the reason you want to do that is because the market is confirming that the stock is being accumulated, is being bought. And the downside of that I would say is that it's really obvious. And I mean, I think it would be like Algo 101 to kind of program where a high is on the market and run it up. And, oftentimes in my trading, especially when I was day trading market making, I would just see these gaps, like these air pockets around highs and lows. I mean, so as you'd be approaching a high, there'd be almost nobody buying right before the high because there's a resistance point. And the second you get above that high, there'd be that flurry of buys that would come in. And so people realize that. And some people, their business is not buying these big long-term movers. If they can break out a stock and slam it back in and shake everybody out for a few percentage points with a decent sized volume, that's a very successful trade for them. And that's what happens a lot of the time. So these algos, especially now that there's all these algos and they're so strong and there's so much money backing them, that they'll, break these highs, break these lows, trigger all these stops and reverse things the other way. And really, it's kind of like everything else. I mean, if you look at, Jesse Livermore, Reminiscence of a Stock Operator, I know it's been He's been spoken about today. Great, fantastic book. But nothing really new happens in the marketplace. So for years, everyone used to chastise the market makers on the floor and you know, all the guys that would be kind of like taking these spreads on these stocks or, you know, triggering stop orders. Well, okay, fine. Everything's gone digital. Everything's electronic. That doesn't really happen the same way anymore, but it does still happen through algos. So, I mean, it's just kind of been programmed the other way. And it always keeps happening because it's human psychology, it's demand and supply. And whether it's 2 or 3 guys in New York doing it, or it's one, you know, giant algo with its server farm somewhere else, I mean, it doesn't really matter. It's still going to take place. So for breakouts, back to the original point, the reason breakouts are great is because, you know, you have the market confirming that the move is happening. The downside of that is that it's kind of obvious and it's very easy to get faded. So typically the way I like to use breakouts is, you know, early in a stock market trend, breakouts work very well because everything's been sold out. You know, look at the coronavirus drop last year, for example. Everybody sold in panic. Short-term traders were short. Long-term guys blew out everything they had to. You know, it's a risk first. You know, when there's a fire, everyone heads to the same exit, tries to get out, and it's a big, massive drop across the board. So when the move finally turns and that bear market is over and the new bull market is starting, all these breakouts work because there's no one is going to be there trying to fade this breakout and for 2 or 3%, because there are no weak hands to shake out. Everyone who's buying these breakouts are funds that have sold lower, guys who are short, people who want and need this stock. So if they're buying the stock at $25 on a breakout, if you bring it down to 24, they're not worried. They're probably gonna say, okay, I'll buy some more of that, $1 cheaper. But you know, as the trend unfolds and you go for many months and you look at some of the big winners of last year at the end, when it becomes kind of obvious and people are tweeting, oh, look at, you know, EXPI breaking the highs. And, you know, at this point, it becomes so obvious. And, you know, traders who are trading short term, they don't have deep pockets. They don't have deep conviction, you know, and if they're buying the stock and they have to sell it on a quick drop because they're cutting their loss, you're just an easy target for the algos. And so it's really these big institutions, when they're coming in like giant whales accumulating the stock, that's a wall of buying that an algo will not fade. And the quality of the buying is different. So when I would be day trading and I'd be, you know, typically very focused on a few stocks and trading very big size in terms of percentage of volume, I could just tell by the way the orders were executing if it was, you know, one-off guy buying some stock or it was someone consistently buying the stock. I mean, I would see like the same, you know, in Canada, we would have a broker number that would show every time an order was filled. But I could tell if it was the same buyer using 2 or 3 different brokers. You would just tell the time between buy, the size of the buys, the percentage of participation of volume. It became very apparent if there was someone who was really urgently trying to buy a stock. So, you know, if I was able to visualize that as a human with my eyes, just watching the stock, imagine with the, you know, deep data analysis that these algos have today. I think it's probably very easy to pick off when it's a whale coming along or when it's a few little fish just trying to take a trade. So that's why breakouts often fail. And that's why I like to use a variety of techniques. I like to use coil patterns, pullbacks, breakouts, and expectation breakers. I want to focus on expectation breakers today because I think it's probably one of the less understood, less known. It's a little bit kind of counterintuitive. And basically the idea behind it is when a stock looks really bad, you know, either we're breaking a low or we're breaking below a moving average or we're closing very weak. You know, most people figure that, you know, the stock is going down. And so if there's something that breaks that expectation, either a gap up or a turnaround after a major low, it usually signifies that the demand supply situation is actually more bullish than you would have realized. Let's take a quick little example of what I'm talking about. So the first example I want to speak about is called the 3 EMA Shakeout. You know, there's many people who have spoken about this type of strategy. There was Larry Connors in his book where he spoke, it was called the turtle soup. There's Gil Morales who calls it the undercut and rally. Jesse Livermore called it a shakeout plus 3. It's all kind of variations of the same theme, but I still find many people don't realize that it exists or how it functions. I kind of use a new twist on it. So basically what I like to look for is for a major low inside a base, you want to see for us the stock break that low. So this here indicates the low here. And what I do is I start a 3-day clock. So I say, look, this stock has 3 days to get itself back above the 3 exponential moving average. I use the 3 exponential moving average. It's just short enough that it's always kind of following price instead of just kind of trying to get a sense of it. Most of the other people I've seen use a similar pattern, just kind of buy if it comes right back above the low, but I found there was kind of too much turnover. So using this kind of simple technique allowed me to participate in these kind of moves without being shaken out too many times in the process in a weak stock. So for example, here we broke on the big red bar here. And on day 2, we closed above the 3 exponential moving average. So I would buy the stock when it trades above the high of that bar. And, there's other ways I use this 3 exponential as well, but you'd be amazed just waiting for it to close above that 3 exponential and trading above that high, how many times that will avoid you from being, stopped into a stock that's kind of just like a fake movement. So that extra step of waiting for the next day and the extra confirmation is a pretty powerful confirmation that the move is happening. And so the real logic that's going on behind this is that this is a major low. Everybody knows it's a major low. Even the day traders know it. The swing traders know it. Even people who are looking at longer term patterns see this low in the 50 days, and they're saying to themselves, well, if we break the low, it should stop at the 50. So there's kind of everyone's eyes are on this low, and once the low is broken, typically when you get to that low, that low exists because someone's been accumulating stock around that low. So once that low is broken, the logic is that the buyer has been overwhelmed, the sellers are more powerful, and the stock is going lower. I mean, that's the logic behind it, and that's why it's called support, that the support is broken, we're going lower. So what happens when the support is broken and you don't go lower? Most people would just kind of see the low broken, they forget this chart, it's a weak stock, and I'll buy the stock up here as we turn around. But in reality, I think highs and lows I call them turbulence zones. So they're important points where demand and supply kind of reach a balance. And by breaking the low, the balance is clearly shifted in the direction of sellers, but the ability to come right back up is telling you something. It's telling you that the sellers are not as strong as you thought, and maybe, just maybe, that big buyer used that as a trap to get even more stock, to get guys to go short, to get the sellers to sell a little more aggressively, and he really wants to buy the stock. So I've seen that before. I remember sometimes I'd be day trading and I'd see a break, I'd go for it, and I'd buy stock, and I'd say, oh man, that big seller, he's done, fantastic. And then bang, he'd come back an hour or two later, and I know the feeling. I'd be stuck there with all the stock that I bought. I'd be looking at the level 2 data saying, oh my goodness, if I got to get out of this thing now, there's no other buyers, because now everyone sees that this breakout failed. So everyone who bought wants to sell. Everyone who was going to buy is not going to buy now because the seller is back. And so very quickly, this stock goes the other way. And that's kind of the logic behind it. And it's sometimes very powerful on both sides. If you look here, the best point to have bought Zillow last year was actually right near the lows. If you would have bought the highs, if you look at this red line here, okay, eventually we went higher, but look, from the second you bought it, you were underwater and this thing went down. And actually, when we took out the highs a second time, it didn't fall down as aggressively, but it took quite a bit of time for this to chop sideways before it went higher. That's probably because we took out the highs and the seller still had some stock left, and he wasn't as aggressive to push it lower, but it still took time to work off this additional stock that was for sale. And so that's the general psychology behind this pattern. And it's really important that you understand the psychology behind all of your patterns. So often, investors use different techniques and they don't really know why the techniques themselves work or what's the reasoning behind them. And I think part of being a day trader for many years, and I mean, trading a few hundred times a day and like having hundreds of orders outstanding, is you start to have a real understanding deep inside you as to how the patterns work, what builds those patterns, because you yourself built those patterns. I mean, I could look at old trades that I made and, oh boy, I was at opening tick, or I was at bottom tick, or I know I saw the fake breakdown and I helped to push it back up. And so you start to get this deep understanding of how these patterns work. And it's always psychology and demand and supply behind every single pattern. But if you don't understand what it is, it becomes very difficult to understand how to incorporate into a larger strategy. So taking the time to understand that it would really improve your results. I'd like to look at a really good example of how to use this. So again, you typically want to be buying strength because you want to be going in direction of trend. But one of the most effective ways to use this through EMA Shakeout is when there's very strong relative strength going on. So this is eBay back in 2002. There were several key elements coming together that preceded its major advance. Two components were, you had a perfect double bottom. If you look at, there's the orange double bottom. There was a smaller purple double bottom, so kind of a pattern within a pattern. But one of the things I think is one of the most important aspects is look at the S&P as we were kind of falling off a cliff into 2002, and look at eBay, how this thing was just going sideways. And the reason why relative strength is so important, especially I like to use it in this way, really comparing the two different charts, is that every stock is benchmarked against the index. There's all these algos, all these models. Every stock has its beta, and if the beta of the stock is 2, that means, let's say every time the market goes up 1%, this stock should go up 2%. People factor that in and buy and sell accordingly. And so if this stock is not falling with the market, that's because there's someone on the other side that's willing to pay up for the stock. Basically, even though the stock is not going higher, whoever was buying this stock during this period of late 2002 was paying up for the stock, because without this major buyer accumulating the stock, this stock would be going lower with the market. It's only the natural progress of any stock is to follow the market. So the ability for this stock to go sideways was someone paying up, someone accumulating the stock, even though the market was very weak. So you had this really big backdrop of strong relative strength inside this pattern. And if you take a minute and you look at the daily chart, you'll see right here and at the second low, we took out the prior low of the double bottom base in late July. And look at that, 1 bar, 2 bars, we closed above the 3 exponential, and then we took out the high of that bar. Soon after, we had the shakeout plus 10% entry, which that's the Livermore entry. Then we had the double bottom, the first double bottom entry, the second double bottom entry. And ironically, one of the worst points to buy this stock on the right side was just above the old high. It took it out by, I don't know if you can see it so well here, by just a few ticks and immediately went down. Doesn't mean it necessarily stopped you out, but it was an immediate pain point. So the fact that you could have bought this way down here and all these multiple points mean that you didn't have to go and buy it at the very obvious point. And another thing I want to bring up right now is why I like to use all of these patterns is it really dramatically reduces your liquidity impact. So when I switched, to my full focus to be, active growth investor, one of the reasons behind that was my strategy had become so effective and so, what's the word I'm looking for? I was so proficient in applying it, but I had liquidity restraints. It was a strategy in a niche market, and it was getting to the point where, the market was quiet and I couldn't put on the size and keep growing my account with the liquidity constraints. So I told myself, I want to make a move to a new strategy, one that, really agrees with my personality and my goals. And I don't want liquidity to be a problem. And so, okay, obviously there's a lot of stocks like eBay, which are fairly liquid, but if you're going to buy, sometimes some of these stocks, even though they look very liquid and they trade 600,000-700,000 shares a day, if it's a quiet day and you have a good position, that thing's only trade, 70,000 shares off the open, and you want to sell a good chunk of stock, well, there could be some really wide spreads. And, I was trading shift 4 payments this week, and they kind of got me on a bad open. And you have a $2-3 spread on a $100 stock. And not only is there a spread, but the stock is dropping. So suddenly you have this 5% cost to get out of the stock. You're pushing the stock lower a little bit, plus the spread that you have to hit the bid. And that really adds up at the end of the year. So one of my goals was to really minimize my liquidity impact on the stocks. And one of the best ways to do that, I found, was to use multiple entries to get in, multiple ways to get out if I want to scale out. And the logical basis behind that was all these funds that are accumulating positions, they're accumulating these stocks for weeks and weeks and weeks. So there's going to be multiple patterns, multiple points that are telling me that the buying is continuing. And that's why I put all of my short-term patterns into 4 categories, and I use them all at different points in the stock cycle. I can amass a very concentrated position very carefully over time with very specific points. And I don't have to wait just for the high of a stock. Or if I do miss the high of a stock, I have many other ways to buy it just a little bit later. So that's why I like to use all these buy points. But to stay focused on the EMA shakeout, this was a perfect entry point right here. And you had fantastic upside. And when you think of risk reward, you have a very small risk here. If you break the lows, you're wrong. But if you're right, just to go back, you're up 290% in 2 years. So what's the risk reward when your stop is 4 or 5% or 3% or 2%, depending how controlled the pattern is, but you have a 290% upside. I mean, okay, maybe I'm exaggerating the upside, that's if you would have held the whole leg, but if you're building a position, which I do sometimes, and for example, when Lavongo was one of my biggest winners last year, some of the initial buys I had, if they would have failed, I would have sold them relatively quickly. But those buys from 27, I ended up selling at $144 a share. So what's the risk reward? I mean, I could be right on one stock like that, and I could be wrong on many, many, many stocks and still be very ahead in my account. And that's my goal. Let's take a look at Veeva. Veeva is another, I mean, I think everyone knows eBay, obviously the online auction site. Veeva is another company that had a booming business. They're still doing well. I mean, just maybe they're a little more mature nowadays. But if we take a look at the Veeva setup here, we had relative strength on multiple time frames. We had, if you look here, the S&P was much lower over 2018. We broke the lows from earlier in the year. Veeva did not, if you look at this black arrow. And even on a shorter-term time frame, the S&P pretty much nosedived into the end of 2018, and Veeva just barely eked out lower lows here in this pattern. And this was pretty much overall a double bottom base. So you had the relative strength background, which is very important because, again, you don't want to just be looking to buy the breaks of lows. You want to use this in the context of all your other principles and in the context of reaching your goal of buying a strong stock in a secular growth trajectory. You just want to do that with the best controlled risk possible. Now, look at this fantastic setup here. We broke the low, and day one, day two, you close above your 3 MA. And you buy above the day two high, and there you had, okay, here in this case here, your risk was a little bit bigger because you had a very big bar, but in the big scheme of things, it was still a relatively low risk entry right off the lows of the December lows, and Veeva turned into a big winner. If we look here, you had 115% move in just 6 months. So again, it's a very powerful setup. Doesn't happen all the time, especially if you're waiting for the bigger context of things. But when it all comes together and coalesces, it's a very powerful way to put this together. Just to, I know I'm running up the clock here. I want to talk about another pattern, the kicker. So I spoke about this with Richard in the video market chat I did with Richard, I think it was the end of 2020. And, some people kind of misunderstood how it works. I thought I'd go into it a little bit deeper. It's a pattern I do use, but I thought I'd kind of dive in with some deeper examples. So basically what happens with the kicker is that you're closing lower than the open. So with candlesticks, when it's a red bar, it doesn't mean it's down on the day. It just means that it's closing lower than where it opened. So a kicker is when, the prior day is closed lower than the open, and we open above the open of the day before, basically above the entire body of the prior candle. So we discussed the psychology of the prior setup. What's the psychology going on here? Well, oftentimes when I was swing trading and day trading, very actively trading, if I was in a bull market, if the stock was, if it was 358, 359, this stock is trading high of the day and there's momentum and we're moving higher, it was a slam dunk trade. Buy the offer, buy as much stock you could get. Next morning, you're going to flip it out just a little bit higher. It was in a really strong trending market, it was kind of like as close to free money as you're going to find. Now, what happens when you're putting that on in this situation here, you're closing weak, everyone's expectation is going to open lower tomorrow. Thank God I sold my stock, or whoa, good thing I got short before the close. And instead of not only do you open higher the next day, you open higher than the whole prior body of the day before. So now everyone who sold is saying, whoa, what happened here? Why are we opening up so strong? There's probably news came out or some kind of market shift. So everyone who sold realizes, oh, I made a terrible mistake. I need to buy my stock back. And everyone who sold short says, oh boy, I'm really cornered now because I'm short and this is gapping way higher. I'm already at a loss, and everyone's gonna start buying this thing because there's some kind of new dramatic event that took place. So I have to cover my short, plus the buyers who are actually lifting this. So you basically have all three aspects of, people who sold who are trying to buy, the new buyers and short sellers coming in to pick up the stock. And that's the psychology of why this works. And again, when you put this in context of bigger patterns, it gives you a very low risk entry. I mean, if you're buying on this gap up bar, if this stock goes negative on the day, so if you open up 4% and you go negative, clearly the gap is negated. The gap was either news that was sold off, or the news wasn't significant enough, or whatever the situation would be. And so you just sell the stock. So if the gap is 3%, you have a 3% stop. It's a really controlled situation, and you know very quickly if you're wrong. But if you're right, because you have all this demand coming in, short sellers covering, sellers buying back, and the new buyers coming in, you usually get very quick moves in your direction. And so that's why it's a very good low risk entry with a lot of upside. If we take a look at Crowd in the big context of things, did you notice that we had a big prior uptrend? Obviously, it's a big tech leader. Did you notice that the kicker was also a 3 EMA shakeout? We broke the prior low, and the day that it kicked, you actually closed above your 3 exponential moving average. And so sometimes it's amazing how all these patterns come together, and they really paint the picture on what the short-term dynamics are of demand and supply. And I would really recommend that you pick a few patterns in each of these 4 categories to come together so that you can adjust to expectation breakers. You're ready to react with pullbacks. You can buy breakouts and stocks that are coiling. You're ready to buy, and so you can really react to any kind of market situation. And the reason you want to be able to react to any market situation is that there aren't that many super fantastic stocks out there. There are many, but out of 10,000 stocks, I mean, you're talking a few handfuls of stocks. So if you find a stock that's a real big winner, you finally get to know the company, you find the fundamentals, and you realize you want to have a big position here, you don't want to miss it. You want to have a way to get in, and having all these different techniques is a fantastic way that I found to do that. One last example here is I just want to talk about Veeva. You probably obviously didn't recognize it before when I mentioned it, but after the shakeout +3 setup here, we moved up, we pulled back one last time, and we kicked right back up. So even if you did miss out on this 3 EMA shakeout, if you said to yourself, oh, this bar is just too big a bar, I don't want to take the risk, you could have bought on this gap up bar here, or you could have even bought on the close of that bar. So there's multiple ways to kind of jump into the stock. And you'll see that once you have all of these different patterns, organized, categorized, you'll see how kind of the market just pulls you into the market when it's the right condition. So if it's the right conditions, these patterns are going to start to form and come in because of that, the demand and supply is shaping that way. And in a big old bear market or a big drop, there's no kicker patterns. You're not gapping up above a prior day. No one's stepping in to do that kind of buying. Or in a big bear market, if you break a low, you're breaking the low and you're going much lower. There's no coming back into the pattern. And so it's just it's a great way to have all these patterns to have the market pull you in bit by bit, make you buy some here, buy some there, and slowly concentrate your winnings into the biggest winner in the marketplace. Sometimes it's frustrating because you have these short-term profits and you give them up. But when this all comes together and you have all these low risk entries and you finally catch a trend, it's just fireworks. And that's the best risk reward type of setup that I found after all these years, is using the larger patterns with these short-term patterns to reach your goal. But again, unless you start with the right goal, with the right principles and the right methods, it won't all come together. So unless your goal is to catch these big long moves, you won't catch that huge move in eBay. You're going to be selling out, and that's fine. If that's your strategy to take short-term wins, I did it for years. I personally made the decision to make a shift in my strategy, and I'm happy I did. I love it. Similar to Jim Ropel, I love everything about growth investing. I love finding these innovative companies. I love the aspect of history and seeing how they worked out before. I love the treasure hunt of trying to see what's going on and how everything comes together. And so that's really what works for me. It's important that you find what works for you, because there's no one system, there's no one approach that is best for everyone. It's really finding what works best for you and how to put it all together. So thank you very much for your time. I think I'm around the 45-minute mark, Richard, and I'd love to take any questions.
Yep. Sorry, I'm just going to turn on my camera for just a second. Matt, really fantastic job. That was really great. We've definitely got some questions here. To start things off, talking about the shakeouts and the kicker candles, are you taking volume into account at all?
Not primarily, because sometimes you can break the low with some pretty sizable volume, but it's just that there could be this big volume sell that comes in, but the fact that it can't go any lower and it reverses back up is usually a sign that that seller may have just been exhausted. Right. So the way some of these sellers work is that they break the low and they have this big block of stock and it's for sale, and someone says, okay, I'll take it. And so boom, the cross happens, or the orders are crossed. and then after you move higher from there. So sometimes the volume is big on the downside and then you come back in. So it's really like a price setup because you're trying to read what's going on in the dynamics.
And I think I saw some confusion in the chat. The context of a kicker candle and also the 3-minute shakeout is very important. Is that right?
Yeah, absolutely. So, I mean, you don't want to be buying these in a big downtrend or down market. You want to see the stock setting up on a relative basis.
Right.
I really stay away from down markets because, you know, buying gap ups in bad markets are terrible. So you want the stock showing relative strength. You want the stock to be in a properly constructed base. If this is a stock, you know, like many last year that broke and you're down 40% off the highs, 45%, 50%, you may move higher, but there's just so many other problems. I mean, that's, you know, we really go into a big scope here and it's like, it'll be way too long to cover in 45 minutes,
Yeah.
but really you want to look for the general character of a healthy stock. And these are ways to fine tune your entries.
Perfect. And talking about limiting drawdowns, this talk is mostly focused on the entries and all of that. But obviously with these big growth stocks, they can draw down 20, 30%. So are you doing anything to protect yourself in that case?
Yeah. So the way I like to do it is because I'm fairly aggressive and I'm buying a lot of different stock. As a trend progresses, I'm always trying to categorize of my stock, and I never have many. It's always when I start off, I'll have maybe 6 or 7. I'll try and bring it down to 4 or 5. But as the trend is advancing, you know, 1 week, 2 weeks, 3 weeks, 4 weeks, I'll know very quickly who my real winners are and who my losers are. So whenever I start to feel kind of very excited and I see we're getting extension for moving averages, I'm very quickly going to start selling my weaker stocks. Even though I'm up on them, I'm going to sell those. And I have a personal rule where I believe that not every stock can go up, but every stock will go down. So when the market drops, everything gets sucked down. So your winners will, your leaders will come down and your losers will come down. But the fact is that your winners will keep going up, but your losers may not. So I always like to get rid of the laggards because you're always hoping they're going to come back and they're going to catch up. But you know what? The leaders lead, and that's just, you know, Wayne Gretzky's the best hockey player. It's not the guy on the bench who's been doing terrible the first 2 periods that's going to come back the 3rd period and be the best hockey player, you know? So that's just the way it is.
Right. And I asked you this a while back in a DM, but on a kicker candle, when are you actually buying stock? Are you looking right at the open, or are you waiting until it really confirms and has a strong close near the end of the day?
So typically, you know, again, the kicker, one of the aspects of the kicker pattern is the red bar the day before. How big of a bar is that? So for example, let's just go back here a second. You know, in this example here, you know, it's a smaller body. It's not a huge body. You know, it's a big bar. So that's what I liked about it, that it was kind of a big support there on that bar.
Yeah.
But the bigger this candle, so for example, look at this big red candle here. If something would have kicked up above that bar, I'm buying on the open because it's such a significant signal. If you have a very small bar, like look at these small little kind of like candle patterns here. Yeah, I mean, you could have technically a kicker there, but it's not as powerful a pattern. The bigger the bar the day before, the more everyone who was sold is caught and has to buy back. So I'll typically look more for the significant patterns and I'll buy them right on the open. And the reason I like to do that too is if this goes negative, basically my stop is what it's up on the day. If we're gapping up 3%, if we go back to negative, I'm out because I mean, we gapped up and we came back in. So it's an easy decision.
Right. And this is just kind of in the general vein of expectation breakers. I noticed like a stock like Peloton recently, this isn't really showing relative strength. So it's kind of a different setup, but after earnings, it sold off hard. The expectation really looking at the chart was it's going to go lower. And then it just refused to go lower and now is making kind of a nice turn on the right-hand side. Is that something that you kind of would play, or because it's not really showing relative strength in the short term, that's not something you're really focused on?
Yeah, you know, I find like every year I try to have a new focus of what I'm really going to focus on. And actually this year for me is the year of relative strength. All of my studies, all of my focuses, I'm trying to bring that aspect of my game up.
Yeah.
And I found that all of my biggest winners always happen when there was relative strength because they're immediate. The market's already buying the stock. The market already wants the stock. And then you have this point of turnaround that just kind of lights the match under the fire. So yeah, just because it's a laggard or weak relative strength, it doesn't mean it can't work, but it has other issues. So I mean, I don't want a problem child. I want where everything's, you know, if I'm only going to have 5 stocks, I want 5 stallions. That's the way I look at it.
Makes sense. And there's a few questions here about the specific buy points you use for, but we talked about the kicker already, but on the EMA three crossover, what's the desired entry price?
So the bar that closes above that 3 EMA, I'll buy it above the high of that bar. So it's really
Gotcha.
simple. So just closing above, but then you want that extra confirmation that you can get above the high of that bar. And you'd be really amazed. I mean, sometimes the 3 EMA, if let's say any stock is just moving really quickly up or down, and I just, I just don't know what to do. I'm not sure if I should get out, if I should hold, should I sell into strength? The 3 EMA, so many times I use it as just even a trailing stop. But I wait for a close below and then the low of that day to get me out. So I find that really, if you look back and just put a 3 EMA on your chart, you'd be amazed at some of the lengths of the moves that could happen before that condition happens, closing below and taking out the low of that bar. So I kind of use the reverse logic here to get in, a close above and then taking out the high of that bar.
Perfect. And one of my favorite parts of the interview you did with me on my channel was when we went through that Lavongo chart and you annotated all your different buys, and you kind of showed how you're using a mixture of all these different tactics to slowly build up your position. Is that something you're always trying to do, and you're not really trying to add more unless the stock is really starting to prove itself through price action and actually increasing in price?
Yeah, so that's exactly what I try and do. But it's really important that you look at the bigger picture, because if you're, these patterns can show up even in an extended stock. So after a stock that's been moving for quite some time, but now your risk is actually quite a bit lower, because if it fails, you're going back to a 50-day or whatever it is. So, but combining these in the proper, big scheme, big picture is really the power of limiting that risk and having huge upside when you're right. So, and what I love about it is, like I mentioned, it's really easy to get very concentrated in a stock. And, typically if you want to have one buy point and you want to put, a quarter or a third of your account in a stock, if you're aggressive, I mean, that's obviously for a very aggressive person. That's not for the average person who invests. If you're wrong and you lose 7% and it's 30% of your account, you take a few of those hits and wow, you're going to be in one heck of a drawdown. But if you use multiple entries like this, I mean, you're never at one point exposed to this big hit right away. I mean, because you're adding over time and as it's progressing, you're always having a cushion build. You're always having some, and without a cushion, putting a big position on, it's happened to me. I buy a stock and bang, that night, financing opens up 10% lower or bad news. I mean, when you invest, anything can happen. You'd be amazed at the incredibly unlucky things that can happen to you when you're investing. So by layering in a bit at a time and having a cushion as you do it, it kind of, as much as possible, protects you from something like that.
Gotcha. And very on at the beginning of your presentation, I saw a lot of chatter about this in the chat about what you meant by this. Could you explain what you basically mean when before you enter a potential trade, you're looking for a 5-to-1 or risk reward ratio?
I get that a lot. Even like some people will snicker about saying, "Oh, how could you know your upside?" It's not that complicated to kind of figure out. If you go back, like I said, and you study past winning stocks, the stocks that are winners all have very repeatable patterns. So all of Bill O'Neill's patterns in his book, they repeat over and over and over. Think about it. This book first came out, I think it was 87 or 88. I mean, you're talking 30 years of out of sample returns of people using them successfully. So if you want to know what your upside is, possibly go back, look at these patterns, look at these short-term patterns, and when they work, what's your upside? So if I'm, that's why I need the bigger picture here. If I'm buying this undercut and rally, or this 3 EMA shakeout or this kicker, if I'm at the bottom of a potential double bottom base, I know one, I have to take out the middle of the W. We're probably going to move up at least 20% from that point, because traditionally that's what successful stocks do. And that's a minimum idea of what my upside is. I don't know if the stock's going to become a 300% gainer, but if my risk is 4% and I can see at least making 25 or 30% return, which is not an astronomical number, well, I mean, do the math. It's pretty simple. You have at least more than 5-to-1, but oftentimes you're looking at these stocks like Upstart, where you have these 15% range days and everyone's excited about it. But if my stop is low of the day, and most people will just say, I'm going to put my stop low of the day. If my risk is 15%, how am I going to get 5 times the 15% on just a regular old move? It's just, I don't see it happening. Or if there's major resistance above me or something, so that's how I kind of build my case. And when you're right, you're really right. And, typically when I'm right, I make more than 5 times my risk. And maybe I'll average out to that between winners and losers, but that's the way I like to approach it.
Perfect. And first of all, Matt, thank you so much for this very structured presentation. It was excellent. And did you want to mention your investing course that you're launching very soon?
Oh, sure. Yeah, thanks, Rich. So I decided to put together an investing course. It's something For a few years, I was an adjunct professor. I taught, the first technical analysis course in Canada at a university in finance. And I enjoyed the teaching aspect of it, but it was just kind of a bit overwhelming with trading and everything and going, students complaining about marks, and I got tired of all that. But I really enjoyed teaching, and people have been asking me a lot of questions. And like I started at the beginning of this presentation, most people don't understand how to put everything together. And that's where most people kind of get confused. So I built a course really to go from point A to point Z, really teach every aspect, how to find ideas, how to think, how bases are structured, buy points, sell points, holding points, monetary policy. I really wanted to build a video course that was easy to use. I mean, I really enjoyed what you guys did at TraderLion. I thought that was a fantastically put together course. And actually, when I saw that it was a video course, I said, "Whoa, this is exactly what I'm working on." It was cool. But obviously, the context is different, but I just thought it was really well structured, and I like that video aspect of it. I find it so much easier to learn. I mean, I like to read, but I know most people don't. So I went with a video style, and it's really to kind of put all of the pieces together in a way that once you understand the psychology behind every aspect of your strategy, you can kind of adapt it to your own personality. So that was my goal when I put it together, and it should be out hopefully in July.
Perfect. Looking forward to checking it out for sure. Matt, thank you again for coming on and being a speaker. We really appreciate you doing this. And once again, a fantastic presentation.
Thank you very much, Rich. Appreciate it.
Yeah, our pleasure. And with that, we'll take another quick break. And next up, we've got Joe Fahmy coming on. And it should be a really great presentation. So stay tuned. Thanks.